Is a $10 million FDIC limit on the horizon? And how could you get more FDIC coverage for your money if this doesn't apply to you? Hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well. So, the $250,000 standard coverage limit that we typically associate with the FDIC nowadays was first set in 2008, prompted by bank failures during the Great Financial Crisis. A lot has changed in the world since then, but not that $250,000 FDIC number that seemed to be cast in stone until recently. As some of you may recall, when Silicon Valley Bank collapsed in March 2023, it was because of a classic bank run. Individual savers and companies that had more than $250,000 in the bank all rushed to get their money out. Now, it's too late for Silicon Valley Bank, but the question that has been discussed ever since is whether a higher deposit insurance limit could make a difference and provide more stability to the banking sector in the future. And that's exactly what a new bill that has been proposed in the Senate wants to do. The Main Street Depositor Protection Act would increase the insurance limit to $10 million from the current $250,000. The new higher $10 million limit would apply for bank deposits protected by the FDIC, the Federal Deposit Insurance Corporation, but also for deposits with credit unions that are protected by the NCUA, the National Credit Union Administration. So, when we speak about banks and the FDIC in the context of this proposed Main Street Depositor Protection Act, know that the same rules would apply to credit unions and the NCUA. The proposed bill is seen as having realistic chances to be actually signed into law, as it has wide bipartisan support. Its sponsors in the Senate are a Republican, Bill Hagerty from Tennessee, and a Democrat, Angela Alsobrooks from Maryland. And a surprise in our polarized times, the increase of the FDIC limit seems to be one of the few topics that finds Treasury Secretary Scott Bessent and Democratic bank critic Senator Elizabeth Warren on the same side of an argument. Both are strongly in favor. That said, the bill is still in its very early stages. It was just proposed on October 9th in the Senate and is now in committee, meaning that there's still a long road ahead until it reaches President Trump's desk for him to sign it into law, if it ever even gets there, because this proposed bill has its opponents as well. First and foremost are the big banks who feel they are being asked to subsidize their competitors. Because if the FDIC limit gets increased, it'll be the big banks which will have to pay most of the additional insurance premiums. But it would be for a measure that is explicitly designed to help their small and medium-sized competitors, whose clients might be the ones most reassured by the new limits. But even if the bill passes as proposed, there is one more limitation, and it's a key one. The new $10 million insurance limit would only apply to non-interest-bearing transaction accounts, so accounts where you can keep your money but don't earn any interest on it. This could be your personal checking account or the transaction account of a small business, as long as these pay no interest. For all accounts that pay interest, such as your savings account, bank CD, or even a checking account that pays you a little bit, the current $250,000 limit would continue to apply. So if you have enough money with the bank, you would have to choose. You can get the new higher $10 million deposit insurance limit, but no interest, or take the interest you can get, but remain stuck with the much lower current limit of $250,000. This is done on purpose, by the way. The sponsors of the bill want to avoid what is called moral hazard. They don't want savers to rush into offers with extra high interest rates from dubious banks, because there could be a risk that these banks may be the ones that would need to be rescued by the FDIC in the end. So in a nutshell, at this point, nothing is really changing for your FDIC coverage. And even if the bill were to pass, it still would not help you with all your money that earns interest, as it should in my mind. That said, There are a few ways you can increase your FDIC coverage right now because I know the current $250,000 threshold has become a bit tight for some in our community. So, with that in mind, here are the 3 topics I'll be covering in today's video. 1. What does FDIC insurance actually cover, and what does it not cover? 2. How can you increase your FDIC coverage up to $1.25 million in certain instances? And what are the risks? And 3, what happens if your bank actually defaults? Let's dive in now, folks. What does FDIC insurance actually cover, and what does it not cover? As many of our Diamond NestEgg regulars already know, FDIC insurance covers depositor accounts at each insured bank, dollar for dollar, including principal and any accrued interest through the date of the insured bank's closing, up to the insurance limit. And the standard maximum deposit insurance amount is $250,000 per depositor per insured bank for each account ownership category. It seems there are quite a few questions around this account ownership category element of FDIC insurance. So I'll be covering that in greater detail later on in this video, as well as some possible ways you can use the different account ownership categories to increase your FDIC coverage within the same financial institution. But first, let's start with what FDIC insurance does cover. If we go to the Your Insured Deposits page on the FDIC's website, which I've linked below, and we scroll down, we can see that FDIC insurance covers all types of deposits received at an insured bank, but it does not cover investments, even if they were purchased at an insured bank. Here's the full list of what the FDIC insures. Everything from checking accounts, negotiable order of withdrawal, NOW accounts, savings accounts, money market deposit accounts, MMDAs, time deposits, such as certificates of deposit, CDs, to cashier's checks, money orders, and other official items issued by a bank. And if we scroll down, we can see the list of investments and other items that the FDIC does not insure, even if they were purchased at the insured bank. So, stock investments, bond investments, mutual funds, municipal securities, and U.S. Treasury bills, bonds, and notes are not protected by the FDIC, even if bought at the failing bank. However, the same securities may be protected by the SIPC, the Securities Investor Protection Corporation, if they're held in a brokerage account at an SIPC member firm. Crypto assets and commodities are not protected by the FDIC and only in some instances protected by the SIPC. So always make sure you understand which of your assets are held in a bank account versus a brokerage account, as this will determine whether the FDIC or the SIPC will be your applicable protection scheme. And always check your brokerage house to ensure that they are an SIPC member firm. The vast majority are, but it's still something to keep an eye out for. And the same goes for FDIC protection. Our focus today is on FDIC protection, but I want to give a quick glimpse as a side note on SIPC protection as well. So, according to the SIPC website, they protect against the loss of cash and securities, such as stocks and bonds, held by a customer at a financially troubled SIPC member brokerage firm. The limit of SIPC protection is $500,000, which includes a $250,000 limit for cash. It's important to understand that SIPC protection is also limited in the sense that it only replaces any missing securities and cash that should have been in your brokerage account when your brokerage firm had shut down, but were not actually there. SIPC protection does not protect against market fluctuations in security prices, meaning that you can't claim SIPC protection if you buy a certain stock that suddenly drops in value. So no, the SIPC will not make you whole if your favorite tech stock suddenly drops in price or even goes out of business. So that was a quick rundown of the SIPC. Let's get back to the FDIC for now. Here's a useful summary of what the FDIC does and does not cover. There are really 4 main buckets that we should be aware of. 1. Deposit products at your bank, including certificates of deposit, CDs, are generally covered by the FDIC up to their limits. 2. Security investments, even if bought at your bank, are not covered by the FDIC. However, they may be covered by the SIPC up to their limits if they're held in a brokerage account with an SIPC member institution. Always make sure you understand where your investments are booked. 3. Insurance products are not covered by the FDIC and are covered only in a very limited way by the SIPC if held via a brokerage firm. SIPC protection is not available for life insurance or fixed annuities and is limited with respect to claims for variable annuity contracts. However, as these are insurance products and depending on the circumstances, some of them may be covered at least in part by an insurance protection scheme at the state level, such as the Guarantee Fund Protection Scheme in New York State. Do check out our annuity video here, link below in the first pinned comment, if you want to learn more about state guarantee associations and the protections they offer for certain types of insurance products, because this works quite differently than FDIC coverage. And finally, 4, safety deposit boxes. The contents in them, as well as crypto assets and commodities, these are not covered by the FDIC. So if you keep cash, gold, or any other high-valued items in your safe deposit box, think twice. Now that we know what the FDIC covers and what it doesn't cover, let's talk a bit about the different account ownership categories and some ways you can increase your FDIC coverage in certain instances. How can you increase your FDIC coverage up to $1.25 million in certain instances? And what are the risks? The simplest way to increase your FDIC coverage beyond the $250,000 limit is to open additional accounts with other banks. The FDIC limit applies per account ownership category, per insured bank. So if you open savings accounts in your own name at 10 different banks, yes, that means that you'd have access to the full $250,000 FDIC protection limit times 10 for a total FDIC insured value of up to $2.5 million. But say that you're a financial minimalist. You want to keep your finances simple and have all your savings in one bank. There are a few different ways to increase your FDIC coverage, even in this instance. Let's start by taking a look at the FDIC's Are My Deposit Accounts Insured by the FDIC page. If we scroll down, we can see all the different account ownership categories. Remember again that the standard deposit insurance amount is $250,000 per depositor per insured bank for each account ownership category. So if my husband Marcus and I have a joint account, this ownership category here, we are each covered for $250,000 for a total of $500,000 on this joint account. To get more details on what qualifies as a joint account, we can click on this arrow here. This also means that if Marcus, his mom, and I owned a joint account together, I know, weird, but it's just an example. If all three of us shared a joint account, that joint account would be FDIC insured for up to $750,000. That's $250,000 of FDIC coverage times 3 for the three of us whose names are on the joint account. But say that Marcus's mom and I don't want to own a joint bank account together with Marcus, because like I mentioned, that is a bit strange. Another way Marcus and I could increase our FDIC coverage at the same institution is if he and I each also open a separate single account at the same financial institution, in addition to our joint account that we have together. Because as we can see here, a single account and a joint account are considered two different account ownership categories and are counted separately for the FDIC insurance limit. Here's what this increased FDIC coverage at the same bank would look like. The joint account that Marcus and I share would have up to $500,000 of FDIC coverage. The single account that belongs to me would have up to $250,000 of FDIC coverage. And Marcus's own single account would also have up to $250,000 of FDIC coverage, for a total across the three accounts we own of up to $1 million of FDIC coverage. But let's say that you're young and are single, or that you just don't want to open a joint account with your spouse for whatever reason. What are your options then for increasing your FDIC insurance at the same institution if you don't want to spread your money across several banks? Well, you could add beneficiaries, what's known as POD, or payable on death. This is best practice in any case to avoid probate upon the death of the account holder. PODs fall under this trust account ownership category. Trust accounts are deposits held by one or more owners under either an informal revocable trust, such as payable on death, POD, or in trust for ITF accounts, a formal revocable trust, or an irrevocable trust. And if we scroll down, we can see that when calculating coverage for trust accounts, the FDIC uses the formula number of owners times number of beneficiaries times $250,000 equals amount insured, not to exceed $1.25 million per owner for all trust accounts. So if you're young and or single, or you just don't want to open a joint account with your spouse for whatever reason, you can add up to 5 beneficiaries to your account to receive up to a maximum of $1.25 million of FDIC coverage. You cannot get more than $1.25 million of FDIC coverage with this method, even if you add a 6th or 7th beneficiary. I've linked this page from the FDIC website in the first pinned comment for those of you who want more details on this. The question, of course, is whether you want to keep so much in cash with one bank. Personally, our preference would be to diversify a bit across 2 or more FDIC-insured financial institutions, to not have all our eggs in one basket, as the old adage goes. That said, I can also see a case for keeping such a large amount with one bank if simplicity is what you're after in your financial life. As I always say, everyone's financial journey is different, and you will need to decide whether your main goal is diversification or simplicity when it comes to your cash holdings. So that was just a few of the different ways you can increase your FDIC coverage if you want to keep all your money with the same financial institution. Now, if you're interested in calculating whether your hard-earned savings are fully FDIC insured at your bank, the FDIC actually offers a useful, relatively straightforward calculator for doing this. I've linked this in the description below as well for those of you who want to play around with it. Here we can enter the bank name. The bank lookup is optional, so I'll just put in my bank. Then I'll scroll down and select personal account, and this section will appear below. For the ownership type, I'll select POD ITF with beneficiaries because I want to add our kids on as beneficiaries. And if I want more information, I can click on What's This right here. And this box will appear explaining what POD ITF means, which I explained in the earlier section already. Under Owner, I'll add my name and select Yes, because, well, I'm still living. And then click on Add Additional Owner because this is a joint account with Marcus. And in this section that appears, I'll add Marcus as a joint owner and check Yes here. Then I'll scroll down and start adding my first child as the beneficiary here. And I'll choose the beneficiary type, which in this case is person. And once again, I'll select Yes here. And I'll click on Add Additional Beneficiary and add our 3 other children. And when I'm done, I'll name the account here. And for the balance, I'm going to put in $2.5 million. We don't hold that much in cash right now, but this is just to show you one more example of how much FDIC coverage we can add to a joint account with our 4 children as beneficiaries. And then I'll select Add to Report. And this is what shows up on screen. Here's a joint account I just added with the make-believe $2.5 million balance. Marcus and I as joint owners and our 4 children as beneficiaries. And as you can see from the balance, because this is a joint account, the $2.5 million balance is split 50-50 between me and Marcus. Now, I'll click on Calculate Coverage. And down here, I can see that I'm FDIC insured for up to $1 million because there are 4 beneficiaries on this account. That's $250,000 of coverage times my 4 beneficiaries. Marcus is also FDIC insured for up to $1 million because there are 4 beneficiaries on this account. But here, this red section here means that we're each underinsured by $250,000 for a total of $500,000 that's not insured by the FDIC. In the event that this bank ever fails, this total amount here in red that's not FDIC insured could potentially be lost. Right. So the great thing about this calculator is that it shows us where our weak spot is, where we might not be covered. If the calculator example I just walked through was a real life example, Marcus and I would now have three options if we wanted to make sure the uninsured excess amount is FDIC covered as well. 1. We could add a fifth beneficiary to this account here. 2. We could each set up additional single accounts with the same bank. Or 3. We could set up a joint account at another bank. Now that we've covered in detail how FDIC coverage works, let's move on to the next section of today's video. What happens if your bank actually defaults? The FDIC has two primary responsibilities when a bank actually defaults. The first is to serve as the insurer of the failed bank's deposits. The second is to serve as the receiver of the failed bank. So, about the first responsibility of the FDIC to serve as the insurer of the failed bank's deposits. This means that the FDIC pays insurance to you and other depositors for your lost deposits up to the $250,000 insurance limit per account and per ownership category. You either get a check or new account at another FDIC-insured bank in an amount equal to the insured balance of your accounts at the failed bank. Where this has happened in the past, and yes, the U.S. is a big country and we have some smaller bank failures practically every year, the FDIC has usually proven itself very efficient and has typically paid depositors within a few days after the failed bank shuts down. However, some cases can take longer. For example, if you have deposits established by a third-party broker or deposits that are more than $250,000 that are tied to trust documents. In fact, over the years on this channel, quite a few of you in our Diamond NestEgg community have shared your positive experiences with the FDIC. We've seen some reports that the FDIC reopened the same old branches under a new name after a weekend takeover. And even the ATMs worked again on Monday. Drop a comment below. Has your bank ever failed? And if yes, what was your experience like with the FDIC? Did the FDIC return funds at the failed bank up to the insurance threshold as quickly as possible? Right. Let's move on now to the FDIC's second primary responsibility, which is to serve as the receiver of the failed bank. In this capacity, the FDIC sells and/or collects the assets of the failed financial institution and settles its debts, including claims for deposits in excess of the FDIC's insurance limit. If your deposits at the failed bank exceed the FDIC's $250,000 insurance limit, it is still possible for you to be made whole if the FDIC is able to successfully sell enough of the failed bank's assets. This would, of course, take some more time, years in some cases, according to the FDIC. However, if the FDIC as a receiver cannot raise enough cash from the failed bank's assets, your deposits that are in excess of the $250,000 FDIC insurance limit would be at risk of either being lost entirely or partially in the bankruptcy, or your excess deposits may be subject to a not-so-voluntary bail-in at the failed institution. In a nutshell, a bail-in means that you swap your deposits for a slice of the equity of the restructured financial institution. Check out this video here to learn more about bank bail-ins and how your non-FDIC insured funds factor into a bail-in if your bank were to ever go out of business. The easiest way to avoid being a victim of bank bail-ins is to make sure that your deposits are fully FDIC insured. I've also linked the FDIC's FAQs page below for those of you who want more details on the FDIC's roles as both insurer and receiver when a bank fails. All right, Diamond NestEgg members, super savers, and course fans, I hope you enjoyed today's video and learned something new. And as always, if you want to learn more about bond investing and building out a bond portfolio while rates are still attractive, then check out this video here on our bond courses, because rates haven't been at these high levels on average in decades. And for those of you who subscribe to Your Financial Journey, check out Ava's latest video on the pros and cons of rolling over your company 401k to an IRA and how to do this via Fidelity. I've linked all the details on Ava's video, our bond courses, and our YouTube Super Saver membership below this video for your convenience. And see you again very soon with more brand new wealth building content for your financial journey.